All right, Matt Davio with Mark Millen. I just hacked it, Mark. Hang on a second. Let me start over.
It's a tough one.
Hang on.
Yeah, when I was in high school, my football coach used to always be Millen. Then I corrected him once. I said, Coach, it's Millen. He said, that's great,
so,
Millen.
I get it all the time with Davio. Davio is actually proper Italian, Northern Italian, but it's been bastardized by Americans that it's Davio, and I just answered it whatever people say. So
Davio, huh? I'm going to write that down.
So, Mark, you are author of a book called High Performance Managed Futures, and I wanted to have you on because this is really a topic near and dear to my heart, which is futures, especially trading futures, and managed futures, which is really getting into the managed money, the managed portfolio side of the futures business, which a lot of people don't know that exists. So very timely. And you also work for PFG. You are a professor of managed futures at Northwestern. You live out in LA.
An adjunct instructor at I taught there a course there. It was a fascinating course too, I thought.
How many? I'm curious. What was the student base like in that class?
It was primarily financial advisors, and it wasn't as well attended as you'd like. I want to say maybe 20, 30 people showed up. But we did an online course as well.
Okay.
And it was a fascinating course because of the people who attended. They were all interested in what's going on, and I think a lot of people are looking for alternatives, and financial advisors are starting to feel this demand.
Yeah. And you're a trader. Are you still a trader yourself? Do you trade at all in the markets? I know you said you used to trade. Do you still trade once in your life?
I was a former CTA. I used to be a newsletter writer, and then I traded people LOD, letter of direction, and then I became a CTA. I had a short volatility strategy on the yield curve.
Okay.
For instance, I'd be selling the puts on the 2s and 10s and selling the calls on the 5s. So I kind of followed a path that, I think a lot of would-be traders, if they want to become professionals, it's sort of a typical path to follow. I mean, there are paths that I think traders can take to become professionals, and this is one of them.
So let's get into that a little bit because you're from Chicago, so I understand how you fell into futures trading, but most people don't really go into it thinking I'm going to be a futures trader. They may start in stocks, they may start in equities or options. Sometimes futures are seen as more exotic. So why don't you walk us through your life path a little bit?
Great. You just brought up some great topics. And here's what stock traders generally discover. When they start to look at futures, I think there's a label on it that it's confusing, it's complicated. But once people start to look at what's underneath it, what's driving the asset class, they understand that with a future time delivery option and the optionality of an options contract, which is a little different, their strategies can be enhanced.
Right.
I know a number. There's one of the larger CTAs in our business was a stock trader, and then he came along and now he's trading single stock futures, and he chooses single stock futures in part because of the contract structure and the flexibility he has with the contract structure. He can really create some unique strategies, and you find that a lot. People who have developed good mathematical algorithms or are generally good traders, they might do well in the equity world, but then when they come over and start to understand futures and options, there's a whole world over here that is very interesting and offers some very unique possibilities to create uncorrelated investments.
Yeah, uncorrelated investments, which is always key, Mark. And the other thing I think is strategies are, again, much to the misnomer, are much more liquid, much more available.
Exactly.
And
I think managed futures is one of the most liquid investments. Direct managed futures account, you can pretty much get out of it on a daily basis.
And you talk about
for the most part.
And you talk about this a lot in your book. Again, the book, I read it. It was just great. And again, I'm in this space. But if you want to learn about futures, your book, High Performance Managed Futures, and if you go to your website, it's go to the number 2 managedfutures.com. It's fantastic because it really gets into what are futures a little bit, but more importantly, what are managed futures, and how does that world look? And that world is pretty small. What do you put it at? About 200, 300 billion is the total dollars right now?
It's under 300 billion. But let's talk about small for a minute, because it's really one of the fastest growing alternatives. I mean, just at the turn of the century, year 2000, I want to say 2001, it was about $40 billion in assets under management. Now it's grown to 267 billion.
Right.
That type of growth has made it the number one hedge fund alternative category. So we've grown from pretty much a cottage industry to becoming the number one hedge fund category. Morningstar in 2010 created a category just for managed futures. So you have to ask yourself the question, what's behind that growth?
Yeah.
Why does that growth, that phenomenal growth, exist? And I believe it's because the performance drivers in managed futures are very different from every other investment. Most investments, stocks, bonds, long-only commodities, they're all driven by economic supply and demand. When the economy is doing well, or the perception of the economy doing well is in place, those investments do well. Now, the problem occurs when the economy is not doing well, and or even the perception of a negative economy comes into place. All those investments tend not to do well. Managed futures, on the other hand, and here's the important point, the performance drivers in a trend trading strategy are price persistence. Doesn't matter if the price of something's going up or down. All that matters is that it continues in that direction,
right.
And that's when trend followers work.
Right.
Spread arb traders, the primary performance driver is price dislocation. They're trading different products, so they might be short the crude oil, long the gasoline. And they're looking for price dislocation, and everything's based on a mathematical formula for the most part.
Right.
That's why I consider managed futures kind of a mathematically driven asset class. Even when you look at technical analysis, it's all pretty much based on a number of mathematical concepts, mean reversion, volume, MACD, all the indicators that you'd look at are primarily mathematically based.
Absolutely. And they're much, as you said, they're much more technical and much more active, which, I think so let's talk about why that works, in my opinion, better in the futures world versus, say, just options or just equities, because of, again, to me, it's one word, it's liquidity in the futures markets that really provides that opportunity.
Well, the liquidity on the futures markets is really amazing. I was a consultant to the Chicago Board of Trade, and I won Chicago, the single stock futures exchange, and I've seen liquidity. I remember when the CBOT launched the mini Dow contract, and I've seen liquidity build to, now I look at the liquidity that's available. It's really stunning how easy it is for a trader to get in and out. Now, having said that, there are different markets, and I was looking at an article just today on how some of the very largest hedge funds and managed futures programs are having difficulty getting in and out of certain markets. I was looking at a CTA today that trades milk. That's not a CTA that has a significant capacity, but the performance of this individual is really sort of stunning. But again, he's trading a highly illiquid market.
Yeah.
So I think the opportunities in managed futures are both in the larger funds, but also there's a whole case to be made for emerging managers and managers that are trading niche strategies as well.
Yeah, and these are all key points that you talk about in your book, Mark, and kind of relaying that. Lumber futures are different than S&P futures, or as you said, milk is different than cotton. Milk is different than cotton. Cotton's different than sugar. They all have their own biorhythms. And I guess that's the point when you're looking at these niche markets is there's managers that are fantastic in milk, and maybe you want to put a small piece, but you're not going to be able to scale to the size you would be with a ES only trader or NQ only trader or Dow mini futures where the volume and the liquidity is large and 24/7 or oil. But again, every one of those still has its own biorhythm. So
right, exactly.
That's one of the things that you're talking about here, and a lot of guys are more macro-driven. They're like, okay, I understand the relationship between crude and heating oil, and crude and gasoline. That's my niche. But then there's also the relationship right now between crude and the ES. So there's a lot of ways that you can kind of
Right. It's actually those niche relationships that are very interesting. A lot of the major relationships, like a crack spread or a soybean oil spread, those are the popular strategies. I was looking at a guy the other day who I've actually followed for some time, who trades oil relative to natural gas, not gasoline. I've been looking at some programs that trade treasuries relative to some ags. So there are some interesting correlations that people are discovering. And I think the niche strategies should be considered. And what happens with a lot of the institutional investors is they're only going to look at a certain asset under management allocation. And really they're missing some of the very interesting strategies. I think a portion of a portfolio should be devoted towards a niche managed future strategy. In an overall portfolio, depending on who the investor is, I like to see some of the major CTAs in it, but I also like to carve out a little bit for some of the niche and some of the emerging strategies.
So let's get into this a little bit. Give me the main difference in your viewpoint when you explain to people the difference. You're a CTA, and you said you became a CTA, so you were a trader that became a CTA. CTA for people is a commodity trading advisor.
Exactly.
So first of all, I want you to describe that, and then lead into how are a typical equity option hedge fund different than a managed futures operation.
Okay. And, just let me highlight the difference between a managed futures operation and a typical hedge fund. Look at correlations and do a correlation analysis, and you're going to find that most hedge funds are actually highly correlated to the stock market. I talk about it in the book in Chapter 9, and, hedge funds, by and large, are correlated to 0.75, which is a pretty high correlation. Managed futures is down in the teens, which is, historically among the lowest correlations of any investment.
So let me just stop you for a second. So to explain that, so if you want to follow the S&P index and the rest of the broadest market view, then most hedge funds are going to follow that. But if you want to invest in something that has really nothing to do with the broader markets, a managed future strategy possibly is something that you could look into.
Right. Now, hedge funds are obviously all very different, but in a general statement, when you want something where the performance driver is uncorrelated to the stock market, managed futures is that tool. And I stress performance drivers because that's really the key to understanding this investment. You have to sort of understand that most investments are driven by economic supply and demand. In managed futures, the investment's driven by market momentum. And that's just a very different reason why money is made or lost in managed futures. And when you start to get into modern portfolio theory and talk at that level, you start to understand that modern portfolio theory works best when the performance drivers are uncorrelated. And from a financial advisor, a lot of people say modern portfolio theory is dead. Well, by and large, they should have learned in 2008 that when you correlate a portfolio, by and large, only using stocks and or stocks and bonds or investments tied to economic supply and demand, you don't have diversification. In my opinion, the only time you can get diversification is when the performance drivers are uncorrelated.
Right. And so this gets right down to the root of, why managed futures are so exciting and a huge opportunity because, as you said, these niche traders and these niche, investor base are looking for these uncorrelated opportunities, which there are many, that the regular markets don't offer. And this is really where a lot of financial advisors are starting to see, I can really put a small 10% piece of my capital outlay into a managed futures, diversified managed futures strategy and really get huge upside to my overall portfolio without a lot of overall risk.
Right. The key for a financial advisor is to set the expectations properly. This isn't a short-term investment. Investors need to give this time because there are different market cycles. And so if you're an investor and you're working with a financial advisor, you should have a discussion of, okay, why is managed futures in the portfolio? And then if that discussion centers around, well, I want diversification, when the economy might not be performing well or when there's an unpredictable market event. Crisis happens, on a very unpredictable basis. I'd like a portion of my portfolio to be doing well when everything else is falling. Right. If that's the objective, then the expectations need to be set up front. And there are times when managed futures is not going to perform positively, and financial advisors need to understand why managed futures isn't performing positively, and they need to be able to look at a market and say, okay, managed futures isn't performing positively because this is the market environment. This market environment does not favor a managed futures strategy. And there are different market environments that favor managed futures and market environments that don't favor managed futures.
And you talk about this a lot in the book, Mark, and one of the things that I always go to, and you bring up a very good point that I want to touch on. You talk about, hey, when you're looking at a manager and how do you, and the difficulties of looking at a track record of a managed futures or CTA, it's difficult. It's not an easy process, and you really go through some of the correlations and things that you need to look for. So let's talk about that a little bit, because the key takeaway that I always get is, hey, if a guy's been around and trading for 10 years, 20 years, whatever it is in a fund, and he's got a decent track record, I want to buy into his drawdown. I don't necessarily want to buy into his success. Very difficult for people to understand, because the way that the hedge fund world works, you know this, I know this, is, hey, the guy's got a great track record. He had a 80% year last year. Well, that's really not the time probably to invest in the guy.
Right. Well, let's start to talk about manager selection. There's a debate about investing on a drawdown, and there are good points on both sides of the argument.
Sure.
I think some of the biggest mistakes I've seen, particularly retail investors make, is by investing after a CTA has had a significant run-up. I tend to believe there's a mean reversion aspect of managed futures. I think that the market cycles go in and out.
Right.
And I think that ultimately, I don't like to necessarily time investments, but if a manager or a managed futures strategy is statistically having a difficult period of time, it's my belief that those strategies have an opportunity to come back and to revert back to a mean. Mm-hmm. Just because market trending behavior goes in a cyclical nature, it flows. There are times when trends are doing well. There are times where trends don't do well. We talked about volatility. The best time to invest in a short volatility option strategy is after volatility has hit a market.
Right.
That's a great opportunity to get into a short volatility strategy, and it's a great opportunity and a great example of investing in a drawdown.
Yeah.
After a short volatility strategy has a significant drawdown is the time that, generally speaking, you'd like to invest, because declining volatility benefits that investment.
Well, exactly. Volatility explosions happen, and those cause pain to those types of strategies. But at some point, they peak and they reverse, and like you said, that's when the cash starts rolling in, and those are very good strategies. And as opposed to maybe looking, at a current environment, in certain financial vehicles. Let's just use the S&P, where volatility is low. It's probably not a good time to sell volatility in S&P futures, but.
Right.
The manager.
Well, what's that old saying? Sell when people are buying, and buy when people are selling.
Exactly.
Some of the best traders, my personal observation of watching some of the traders in Chicago, some of the best traders I know in Chicago know how to stand in a pit in the middle of market chaos and go against the grain.
Yeah.
Now that can be a risky strategy, and the investors have to understand all the risks in investing. And some of those guys I've seen down in the pit are, their risk-reward profile is pretty significant. But it's also funny when you start to look at their portfolio investments. Sometimes a little different than their trading strategy on the floor.
They're more spread versus directional, aren't they? In their own personal stuff. Because
they're a little more hedged.
Well, that's what I mean by spread. I mean, they're limited risk on both sides. If they really can't hold it and manage it day to day, it's a whole different thing. So let's talk a little bit about regulatory requirements for managed futures, because again, I think there's a lot of miseducation out there that it's the Wild West and it's gunslinging. When actuality, I think it's more severe than the SEC is with stocks and options.
I can tell you read Chapter 5. Chapter 5 is titled, How to Prevent Bernie Madoff-like Fraud. And in a direct managed futures account, which is regulated by the National Futures Association and the Commodity Futures Trading Commission, the structure is extremely different from that of the SEC and FINRA. Not to say the SEC and FINRA are necessarily bad, but right. Bernie Madoff fraud could not have happened in a direct managed futures account. There are a couple things at play. In Chapter 5, I talk about account segregation. This is in my opinion, a very important investor protection. When you invest in managed futures, a managed futures trader does not have direct access to your capital. The money doesn't go into their bank account. There's also a benefit of cross-party counter surveillance and transparency at work in a direct managed futures account. Now, this is very different from a lot of the fund structures, which are not transparent, which do not have cross-party counter surveillance. So, why the investment world hasn't really taken a look at how a direct managed futures account is regulated and some of the investor protections is beyond me. I think it should be news. I was trying to raise the point during the Bernie Madoff discussion that this would have never happened in a direct managed futures account. And why don't we take some of these transparency benefits that are in a direct managed futures account and apply to a fund account? Right. And I have spoken with a number of the larger managed futures mutual fund companies and the managed futures fund companies. There's possibilities to introduce a degree of transparency into what's happening without necessarily giving away the algorithmic secrets. Right. So I think transparency is a good thing. I think our industry, managed futures, is based on some investor protections. I think these are benefits that should be touted.
Because I think the point you're making, Mark, is what's happening is the customer still can look at their account on a day-to-day basis, but without having to know exactly why those trades were made. But yet they can say, hey, my money's there. It's in my, sub-mask account, 123 under ABC, and I can see that, the fund was up 1%, last week. And I can see that we're long this, short this, but I'm not going to understand the reasons behind it, which again allows the manager some freedom to allow for that transparency, but also allow for the investor to feel comfortable that their money is where it's supposed to be.
Yeah. Now, in terms of investors, I do kind of advocate that they understand at the basic level what's going on, and that's why I focus on the 4 key strategies. And I think investors should understand the strategies, and or they should be working with someone who can explain the strategies to them. And then you need to follow what the manager is doing. If a manager is a short options volatility strategy, and all of a sudden you see them going in a trend trading strategy, that's called strategy drift. That's, a yellow or red flag in a risk management system. So there are a lot of ways that, at a basic level, I like investors to understand the strategies, understand how to look at their liquidated value, which they can see on a daily basis in a direct managed futures account, and have a reasonable idea of how the margin equity is being managed. Right. So, primarily when someone invests in managed futures, I like to give them that basic education.
And I think that's totally rational thinking. As far as the base is considered, it's a growing marketplace, but who should invest in a managed futures product and why? What are they, we touched on a little bit on why, but give me a little bit more on who should and why should they invest in managed futures.
Okay, well, let's start with the why, because I think once you get the why out of the way, it sort of leads to the who. I think there are a number of reasons people invest in managed futures. One of them is absolute returns. You're looking for an absolute performance driver, that can generate returns. The other reason that I think is really probably the more long-term, the more sound, is portfolio diversification. Mm-hmm. I think when intelligent investors look at a portfolio, they want a portion of that portfolio dedicated to an investment that isn't driven by economic supply and demand. Mm-hmm. None of us know what's going to happen in the future. I tend to believe we're in a debt-filled environment, and I think we're going to have difficulty moving forward. And I think that we could see commodity inflation hit the markets as a lot of third world countries start to develop and you could gain an appetite for oil, gold, and wheat. I think our economic future is unclear, but here's the point. I don't know what the future holds. I don't have a crystal ball that works 100% of the time, and no one does. Right. That's why I think investors should devote a portion of their portfolio to an investment that isn't necessarily tied to the economy and the stock market. Mm-hmm. So that's the why. Once you get that first, get that straightened out, then you start to look at who. Institutional investors have pretty much been in managed futures for quite some time, but I'm even seeing a lot more institutional demand come in recently. Financial advisors are just starting to understand this investment. And again, when I talk to financial advisors, I try and point out the diversification component. And I think that their clients, they're going to divide them into different areas. High net worth investors, I think they should be given the education at a sophisticated level, and if they're comfortable with it, then they should move into it.
Right.
The more retail investor, I'd really like to see them in some of the top products, and the problem with the retail investor is they come into managed futures, and really some of the better products have very high account minimums. Now, there's some mutual funds that are coming in, and there are some funds that are starting to come in to answer these questions. And actually, if a retail investor is speculative or aggressive in nature, they can invest in some of the emerging managers which have low minimums, but by and large, the more serious and the more established funds have higher minimums. That's one of the issues in managed futures.
Do you think
retail investors, I advocate diversification. I think that's the best risk management.
Do you see, so that leads, you brought up a point that a lot of the good funds are restrictive. Is that intentional, or is that because they've grown to a size where they can demand that from their customers, and it's easier to take in $500,000 than it is 50,000? And with that, are there ways that are there funds that the smaller guy can put 50,000 into that allow them access to a handful or a group of managed futures?
Well, for a non-qualified investor, it's very difficult. And that's one of the problems I have with the regulation as it currently exists, is, the worst selection in managed futures is for an unqualified investor, an average retail investor.
Right.
There are some good programs at $50,000, but you can't get the strategy diversification.
Right.
There's an excellent short volatility option strategy at $50,000, and I would pair that. There are some really good trend traders at $50,000 to $100,000, some good discretionary traders at $50,000 to $100,000. But basically, in order to get a reasonably diversified portfolio, you need about $150,000, $250,000 to invest.
Right.
And then the alternative to that for a smaller investor is going with a single manager. And then there's some emerging manager, and there's some emerging manager programs that are very interesting, but they're highly speculative. And again, this is like that farm system I was talking about. There's a whole farm system for emerging managers, and the volatility can be pretty significant, but I've seen some pretty amazing triple-digit returns. But whenever you look at triple-digit returns, you also have to understand those returns are achieved with a certain degree of volatility. And so that's where you have to understand an investor, and you have to clearly outline to an investor, okay, this is a volatile investment. It's going to go up and down very rapidly. And I find that, when we talk about investing on a drawdown, I find that with these sort of emerging managers, that's really an interesting strategy. And that's my advice there.
Yeah, so again, a guy could be up 7% this month, down 12%, up 18%, and
I've actually seen bigger swings than that. I've seen guys up and down 20, 30% before.
So how do you educate the buyer of said products that have these swings? Because they are, and we're not saying all futures funds are like this, but like you said, if you want a large return, you can expect some big swings at times. So how do you educate the guy that maybe has been used to a consistent anywhere 10 to 30% return in equities? He's had a good hedge fund, stable of people that he's invested in, and now wants to plow some of those profits into a non-correlated, futures fund. How do you educate them on maybe some greater upside?
That's a great question.
Greater risk.
That's a great question. And here's where it starts out. You have to first start out by, I like to identify a risk-reward tolerance. What's your risk-reward tolerance? What's your tolerance for volatility? Do you understand what volatility is? And as you go down these paths, there are different CTAs and different groupings of CTAs. What I was talking about previously with the emerging managers, that is the most aggressive of the managed future strategies.
Right.
And for certain conservative investors, that's just not the right approach. And as a matter of fact, as you start to go down the path with certain investors, you realize some of them, managed futures just is not appropriate for them. If they don't understand volatility, if they don't understand the basis of the investment or are uncomfortable, I think the appropriate response is to say, I don't think managed futures is for you.
Right.
So then, you go down a path and you identify how sophisticated an investor is, how they understand volatility, how they understand drawdown risk. Then you start to get in a portfolio design with people. Once they they sort of meet those hurdles. Then you start to say to people, okay, if I can put different volatility levels in a portfolio, you might see individual volatility among these managers, but they're designed with a volatility skew so that the overall portfolio is going to be operating smoothly.
Sure.
And once you show that, once an investor understands that, that's typically a moderate investor.
Right.
And, for a moderate investor, I'll put a couple aggressive programs in a moderate portfolio. Just so long as the performance drivers are a little different, I don't think that's a bad idea myself.
And along with that, Mark, do you see, as you said, especially in this emerging farm concept, which, by the way, I think is a great idea, there's a lot of good traders out there, as you said, mathematically or algo inclined, still are swinging over to this world, and I think you're gonna have a lot of good traders coming and greater liquidity even from where we are now come into the managed future space because of the additional players that I think will come in. But do you see when you're putting together this portfolio for customers, sometimes do you look to also diversify the scale of said new investors with more tenured investors? So size, you may have a Tudor Jones if he had a fund that was open still, and a new aggressive. Do you combine those also, and along with your volatility skews that you're putting together?
Well, it all depends, and here is where it gets sort of interesting. A lot is driven by investment minimum. So I'm going to give you a couple examples. When I just did a portfolio for someone yesterday, $250,000. That kind of hamstrung me in terms of the selection I had available. It's not a bad level, but you just at $250,000, I'm looking for investment managers with about a $50,000 investment minimum.
Right.
Ideally, I'd like to get 4 managers in there, 5 managers that have different strategies, but you're really restricted. I just developed a portfolio for someone, $8.5 million. Very different portfolio. This investor is a little more concerned about capital preservation.
Sure.
But with that type of portfolio, he understood volatility. And so I said to him, okay, there's a portion of your portfolio I want to devote towards a high volatility strategy, an emerging manager strategy. But it's only a portion of your overall managed futures portfolio. So with this particular investor, because he understood the concept of volatility, I'll volatility skew the portfolio. So in this portfolio, you'll see, operations like Winton, which is probably along the par of Paul Tudor Jones. So you see like a Winton. There's some interesting programs, at that level that are in there.
Right.
But then there's also some diversification. The short volatility strategy. There aren't as many of those Winton type short volatility strategies, but there's some very good programs at some lower levels that most institutional managers overlook. I'm saying it's true in spread trading. There's some very interesting spread trading strategies that I really like to put in a portfolio. So these might not be the well-known strategies, and if you look at managed futures, maybe there are 15 of the top strategies that are typically the go-to, the kind of same old strategies. But if you look at them, by and large, they're mostly trend followers. So the performance driver isn't as diversified. I like to diversify performance drivers in my managed futures portfolio. So when I develop an $8.5 million portfolio, it's going to be a little different than a $250,000 portfolio. But the one thing that's consistent, it's all going to be strategy diversified and performance driver diversified.
Right. So you have a little bit of the herding mentality on the high end, and then you try to bring up that higher volatility and put pieces of that into the new emerging investors and some of the pieces that are more unique and create a little different flavor for everyone depending on their risk appetite.
Right.
So the next question I lead in, and obviously you do a lot of this, how does somebody that likes your pitch and likes what you're saying, how do they find out about some of these managed futures funds? They're not, again, most advisors don't know about them. They don't talk about them. They're not pitched well enough on them. How would I go about, putting together a portfolio in this area?
Well, it's an interesting asset. I was having a conversation the other day with a journalist who positioned this question very good. She says, how do you shop for managed futures?
Yeah.
And it's really difficult.
It is.
Quite frankly, I mean, the information is not widely available. So I have my website, go to managedfutures.com, and what I'm actually in the process of building is a needs analysis calculator. So essentially, you come through it, it's going to ask you questions. And then to determine your level of knowledge, your volatility tolerance, your tolerance for risk, and then at the end of the application, it's going to give recommendations based on that. Now, anytime you use computer-based logic and if-then logic, the recommendations are not going to be perfect, and there's limitations to mathematical logic.
Right.
But I think what it really does is it's an education tool, because as people answer questions, they're going to, maybe come to the realization managed futures isn't right for them. Or they're going to, it'll cause them some introspection. How do I feel about volatility? Am I comfortable with volatility?
Yeah.
How do I feel about drawdown risk? How do I feel about the concept of an investment that, is designed for diversification? So, I think that that's an application. And I think most managed futures representations that are available to financial advisors, they really don't have a great selection. They have a couple of ETFs which follow the diversified trend indicator, and it's really, it's underperformed the managed futures benchmarks by significant margins. So really what's available to the retail investor through a financial advisor right now is limited. There are some mutual funds that have been developed that understand the concept of diversification, which is good. But there needs to be more growth in that area.
So, one of the questions I had here on my list, and you kind of answered it here, do you think it's more advantageous to find a good portfolio of managed futures versus an ETF fund that is volatile?
Absolutely. I don't think there's any question there. I mean, here's the whole thing about the ETFs that are out there right now. They're based on this diversified trend indicator, which is really a singular formula. At the end of the day, if you look at some of the more sophisticated managed futures programs, such as a Winton, they have 100 different physicists and mathematicians on staff that are working different algorithms and formulas. In managed futures, most programs do not rely on one formula and one indicator. These ETFs are relying on one formula and one indicator, and it's just not as effective. And the proof of the pudding is in the eating. Look at the performance of the managed futures ETFs and compare it to industry benchmarks. It's significant in the performance.
This is always my argument. I'd rather trade with somebody who trades the vehicle specifically, or the underlying specifically, versus, and that goes for ETF. I'd rather be with the trader that trades the ES over the SPY all day, because the SPY is all related, is a derivative of the ES. And it's so difficult to explain that to people at times. Or I'd rather trade oil than OIH. I mean, they're just not directly the same. I mean, they never will be. So
now you're talking about trading, and there are a couple different ways to look at that. But from an investing standpoint, a managed futures ETF, managed futures is a high alpha investment.
It is.
It's an investment. It's an active. By definition, it's active. The word managed implies it's active. Most ETFs are passive.
Yep.
And I don't know that an active strategy would ever necessarily lose out to a passive strategy in managed futures, just because it's such a high alpha investment.
And by alpha, you mean return, which again typically implies a greater volatility, and then that means more activity, which leads to better performance ultimately if everything goes as planned. Which we all know things don't always go as planned. So again, where am I going to find these fine managed futures products that are out there in this $300 billion marketplace? How do now that I'm sold, I want to invest, I want to learn more about portfolio management. I don't want ETFs, I don't want exchange traded contracts. I want the real deal. So again, where do I, as somebody who's got, a $500,000 to $1 million lying around or any number, where do I go find these? How do I find the guy who's going to help me with this?
Well, first you'd have to find if you want a direct account, I think, one of the questions in my need analysis calculator is, what do you want, a direct account or a fund account? Essentially I describe them. If you want the transparency, the investor protections, you go with a direct account. If you choose a direct account, you have to work with someone who is affiliated with a futures commission merchant or an introducing broker. So that's pretty much what Peregrine Financial does. So, investors come to us all the time and they say, I want to diversify my portfolio using managed futures. And then PFG Best has, for instance, a portfolio development application on their website. You can get it through my website at gotomanagedfutures.com. But essentially, you can develop your own portfolio. So if you're the do-it-yourself guy, you can come to this PFG application, and there's been a limited amount of filtering done on the CTAs that are on that database. There's about 100 or so that have met the filter criteria, and you can do it yourself. You can pick them out yourself. Or you can talk to someone like myself. You can talk to anyone who's familiar with managed futures, and they'll give you recommendations. It's my opinion that if you don't know what you're doing, you should be talking with someone who does and who can explain the strategies to you, and who can say, because there are some traders who have posted amazing compounded annual returns. I talk about this in chapter 10 of the book. You could say, oh wow, this guy has 26% annual return. Well, if you're making decisions based on annual return, there are studies that show that that's kind of a failed method to analyze managed futures programs. So I would suggest for most investors who don't understand the space, they should contact someone like myself or someone familiar with the managed futures space who can help guide them and point them in a direction. Now, if they're a trader and they have talent and they want to pursue a professional trading career, then there's a path. Again, they could contact myself or they could contact, people at PFG who would put them in touch with a whole trading program. It starts them out, okay, here's the steps to become a professional trader.
Talk about that a little bit, Mark, because we did want to talk about that a little bit. So let's talk about kind of that bullpen concept of grooming, young, not necessarily young, but, people maybe that don't have that exposure as traders. What does that program look like?
Well, here's sort of the issue. Here's sort of, in my mind, where it's all sort of sprung from. In Chicago, there were always a great number of traders, and a lot of these guys would spin off the floor, and particularly once it started to go electronic, a lot of these guys spun off the floor, and it created sort of a demand for channeling talent. And so I've seen both professional traders off the floor and, more appropriately, mathematically based traders from all around the world who need to get a start. They need to start somewhere. So if, the first step is their proprietary results, and, they would come aboard in sort of an incubator program, and we look at their proprietary results, and then we enter them into a couple contests. And then, if they pass a couple hurdles, then we enter them into, there's one program called the World Cup Advisor. We'd enter them into the World Cup Advisor program, where they operate letter of direction. And then investors can follow these, managers. And this is sort of that bullpen concept I was talking about, where the returns can be pretty significant. I personally believe that if you're in this program, you should be focusing on consistency, not necessarily hitting the ball out of the ballpark. But there are guys who are hitting the ball out of the ballpark. But that gate swings in both directions, and investors have to be aware of that volatility and risk. Then once they do that, then the next step is to become a CTA. A registered CTA. Now, there are different variations to this step, this process, and, some people come, I was talking to a guy today who was a professional Wall Street trader, been a hedge fund trader for 10 years. Now he wants to get into managed futures. And so I outlined to him the different options he has, and the steps he'd take. A former hedge fund trader who has a professional background would probably take a little different step than a retail trader who is not as well known.
Right. And again, so everything is customizable, and really, what do you want to do with your product? Do you want to market? Do you want to find money? All these things need to be kind of vetted out before you even jump into it. And just because you traded stocks in the hedge fund world and options, there is a learning curve, and these are different products and different correlations. So although a lot of the same mathematics work, there's also a lot of nuances that are different that must be, again, vetted out by the individual trader and organization as you get into this. It is a different world, but it's one that I highly find very satisfying as a trader myself, and have made that full switch over from 15 years of equities and options over to pretty much exclusively on the on the future side myself. I just find it to be most friendly as a trader, and I'm just talking from a trading perspective, and from an alpha generator. So I agree with you. It's an alpha option for you. So if you enjoy volatility and you enjoy some non-correlated products, this is just a market that more people need to educate themselves on. And again, the key thing here is always, educate yourself, figure it out, find out if you'd be comfortable in these flows, because they're much different also than anything probably most people have seen.
Right.
Well, I appreciate it, Mark, and we'll have to talk more here because I've definitely taken enough of your time, and I want to stick to the time limit here. But I'd like to have more of these conversations because I think we can really do some justice in trying to educate folks, and you've really brought a lot of value for me here today, and I hope the viewers find the same. Appreciate it.
Well, likewise, Matt. Thanks for the time.
Okay. Thanks, Mark.
Take care.